Hi there, Sean Howard here from Mortgage Architects. So, you're thinking about refinancing. One question you should ask yourself, and you probably already have at this point if you're familiar with the term, why are you refinancing? Some of the good reasons to refinance is if you're taking the money and reinvesting it in your home, like doing renovations, for example, or something like that. Or you might be refinancing to purchase another property, which we'll discuss in another video. Some of the questionable reasons for refinancing is to pay down a loan on a depreciating asset like a vehicle, for example. And the reason why is because if you pay down a vehicle by refinancing your home, you may be paying a lot more for it in the long run than you would have if you had just stuck to the original loan that's being paid down more quickly. With a mortgage, we're talking about, 25 years, let's say 15 years, whatever the case may be. When you pay off a $7,000 loan over the period of that length of a period of time, it becomes very expensive. It adds up a lot. Now, having said that, if the reason for refinancing is for cash flow, because you have credit cards and the car loan or other debts, and we're all about quality of life here in our office, then that's also a good reason for sure. Okay, so you don't want to jump to refinancing your home to pay off something like a car, but on the other hand, you need to live. So if you're overextended with your other unsecured debt, credit cards, loans, unsecured loans, vehicles, and so on. When I say unsecured, it's anything that isn't secured by a property. Then that can be a good reason to refinance. Now, the process when refinancing is, and one of the first questions we'll ask you is, how much do you think your home is worth? Okay, that may require an appraisal to verify that in some cases, unless we know that it's worth way more than what you're asking for. We can only refinance up to 80% of the value of the home, the appraised value of the home. Okay, so that's one thing to keep in mind. The best time to refinance is usually, if possible, when your mortgage comes up for maturity. And obviously we don't want to wait until it comes up for maturity, but we want to time it so that you're refinancing when it matures. So we'll get the ball rolling and get all of the documentation and paperwork in place a few months in advance, 3 months in advance, so that we're ready, so that when it matures, we're ready for it. And then we either stick with the same bank and add the additional money and create a new mortgage with the existing bank, or if the terms are better elsewhere, then we'll move you to another bank and refinance with them. And because it's at maturity, then we avoid the penalty. Now, in some cases, you can avoid the penalty. I mean, you need the money now. You're 2 years into a 5-year term, and you need to pay out that car loan because you're living off Kraft dinner at home, or the no-name stuff, which is sometimes better. But anyway, so in that case, you're gonna pay either a penalty to get out of your existing mortgage, and we can help you do the numbers to decide which scenario is best for you. Or if you stick with your existing lender, you may be able to do what we call a blend and extend, which means that it takes your current contract with them for the lower amount of the mortgage, and then you combine it with the larger amount and you blend it together, and then you extend it for another term on the new mortgage. okay? But the objective is to get the extra money, to pay out the debt, or to do the renos, and if at all possible, to avoid any penalties. Now, when you refinance, you will have to qualify for the mortgage. So again, as we've talked about in our other videos, they're going to look, starting from scratch again, they're going to look at your current credit, and they're going to look at your income. And in this case, they're not looking at a down payment because you're not buying a house. So it's a different term. They're looking at the equity in the home, okay? So that's where the appraisal comes in, and that's where they check the value of the home. So you can borrow up to 80%, meaning that you need at least 20% equity left in the home. That gives the bank a buffer, okay? The rates when you refinance are not as good as if you're purchasing a home with a large down payment, or if you're putting less than 20% down. Generally speaking, refinance rates are higher than the rates that you would get if you're purchasing a home, okay? Not that much higher. Right now, it's April of 2020, and purchase rates can go as low as 2.5%, plus or minus, and refinance rates, we're talking more around the 3%. But you have to look at the big picture and see how much you're saving on your debt, if that's what you're paying out, or how much you're improving the value of your home by doing the refi.